what is your biggest pet peeve when entrepreneurs come to pitch you? If you had one thing that you would tell everybody, just don't do this on pain of death, what is it? And we'll start with Kathleen to begin with. She said that with her last name, she usually goes last. We'll make her go first this time, and then we'll reverse the order later.
Well, my first answer, which is kind of serious, kind of joke, I am not the assistant. So I would say definitely know who you're meeting with and maybe look at their picture before they come get you. Because that's not a good way to start, especially with me. And I hold a grudge for at least a half an hour. But more seriously, only a couple people have done that. So more seriously, I like to ask questions. I interrupt. And so just go right to the slide or just answer the question and not say like, oh, we'll get there, or be like obsessed with having to go through the pitch, because especially if it's in like the fintech area and some people are pitching a lot of investors that don't understand fintech. I understand the market sometimes. So if I'm like, okay, we can skip through that, we can skip that, like you don't have to convert me, I'm right there with you. Like then just move along, because if you can't be that flexible in a meeting, I always wonder like, how can you, hey, welcome, come join us. This is my former colleague, Andrew Cleland. But if you can't be that flexible, in a pitch or in a meeting, then I worry about how you're going to actually run a startup.
Yeah, my biggest one, I think, happens probably more than 50% of the time, but I always find it interesting that a lot of entrepreneurs will come in front of our whole investment committee. You got 6 guys around the table. They sit down and they go, well, how do you want us to run this meeting? And, look at it. We look at it as we've invited you in, you've come in to pitch the entire team, and it's really your meeting and your meeting to run. So I think starting with how do you want to run this, or how do you want to do this? Look at it as it's your meeting, and, take charge and run it the way you want, and we'll, give you advice and iterate as we go along.
So we have a checklist on our website, as do many VCs, on what we look for in a pitch, ffvc.com/pitch. And 95% of pitches we get fail to pay any attention to the checklist. This is not unique to FF. It says, talk about your financing history, how much money are you trying to raise, tell us about your team's background, etc. What we normally see is people highlight a couple things, and then they try and hide the bad news, if there's bad news, or they try and skip over stuff they don't want to discuss. But anyway, any halfway competent VC will ask you about your financing history. And if you had a down round or you fired a co-founder or whatever, that's okay, right? Like that happens. But don't try and just bury it, because it's just annoying. It makes it look like you're puffing your company and are trying to hide things from you as an investor, which is not a good way to start a 10-year relationship, which you cannot readily exit on either side.
I think for me, credibility is sort of respecting and understanding the competitive environment that you're operating in. So when I ask about sort of the market dynamics and you say, we're unique and there's no one else that does what we do, it's not a good answer. And really it's taking the time to understand the industries you're operating in. And sometimes that's hard to access, but it talks about sort of, taking the time to reach out and get to know your competitors and understanding that impact for how it shapes what you want to do in the market.
Thank you very much. That's great. So next question, very, very different. And then I'm going to let you, I'd like to have a little bit of discussion among you about things that you're interested in, your compatriots here. What's the one investment that you turned down? So not that you got shut out of, but the investment that you turned down that you really wish that you had said yes to. Now maybe you're perfect and you haven't, and there hasn't been anything that you've missed out on.
I'm just young, so I haven't gotten there.
There's a lot. The one that ran through our firm we should have did was diapers.com. And we should have did their first round, and we couldn't get over the margin equation, and we missed it.
Okay, that's a good one.
So as a firm, Wanilo, we came close to investing in, didn't. Fab, we looked at past at the time, which depending on how that story turns out, then maybe that was a good move.
We don't know yet. Yeah, exactly.
We won't talk about Fab. But that's life. You in this business are going to see many, many, many companies. We look at 2,000 a year, and we invest in about a dozen. So we try and spend our energy looking forward, not backwards.
Yeah, you know, it's hard, as you know, Kathleen kind of mentioned, we've been doing this since 2011. A lot of our investments have been, you know, kind of 12 and 13. So we've seen a lot of stuff, passed on a lot of stuff that I know will go on to be, you know, really great, but hasn't really materialized yet. But I think the one that, you know, outside of kind of how we try to live, you know, in the valuation and stage standpoint, the one that we saw that fit literally almost everything we believe in and had one of the most amazing founders that we've seen to date that we passed on was Little Bits. I think those guys will go on to do, you know, a lot of really cool stuff and big stuff and really change the way, you know, child interaction happens with technology. And so I think we'll regret that from a financial standpoint, but if nothing else, we regret kind of passing on one that really fit the bill.
I'm in his same boat, and I'll steal yours. I guess I didn't invest in Little Bits either, and I saw that, and we got close, but didn't get there.
All right. One final question for you. As you're looking, so I think David's point about the checklist on the website is a really good one. That, you know, first of all, obviously as companies, know your investors. And we talked a little bit about the thing that you didn't like. What's the one thing that people could really do well? You've kind of answered. You know, Ryan's given part of his answer. You know the market. If you had one thing that somebody comes in to pitch you that you say, wow, they really have their act together. Is there anything in particular that people can do that's replicable, or is it really just to be prepared? What's the, you know, what is there out there that's like the little thing in the background that might not be obvious to people who haven't seen all of these? One thing I will say is that I, as a lawyer, see lots of companies come through. We talk to lots of people. I pitch lots of people as well, and you don't always have a good sense as the pitcher what it is that people are latching on to. Like, what is it about the pitch that they like? So is there anything in particular that you find that people do well that sets them out just from a communication standpoint? Kathleen's nodding, so.
All right, so people that listen. So, and it really is, because I might be interested in one area and not the other. And if I seem excited about one area, they should go into it. If I don't see them, they should just skip over it. If they're listening to me, I'm assuming they're going to listen to their customers, they're going to listen to their employees. And it's not just all about, let me get this pitch done. It's like, let me try to understand, process, and move forward.
Yeah, it's hard. I mean, I think, you know, in many cases, you know, just to be prepared, and the kind of dynamic entrepreneurs are great and easy to pick out. But I think, you know, one thing that we see a lot is guys almost oversell the business to the point where they're kind of, or the opportunity in the investor market, that they almost feel nonchalant about you. It's kind of like, yeah, I'm here, I'm going through the motions, but you know, there's so much demand for what I'm doing that if you don't say yes, one of these other 15 funds will say yes. And there's certainly the piece of it where you guys should sell yourself and seem confident about what you're doing. But when it feels like, hey, you're just one of, you know, a dozen guys that we're going after, I think it starts to become off-putting at some point.
So the fundamental insight of the lean startup movement is that a startup is like a scientific experiment. It's an attempt to prove a hypothesis. If you look at how scientists actually do work, they all start by looking at the prior art, the prior research, look at what those studies found, and then try and do something new. They try and fill out white space. So what almost no one does, but would certainly impress me, is if you came in and said, here are the 5 other companies that are trying to solve the same problem as us, here's what they're doing wrong or why they failed, and here's what we're doing differently. Why should you go through the burden of learning about product market fit when there are 5 other competent funded teams out there that are trying the same thing? I would learn as much as you possibly can from them before you spend our money trying to figure it out yourself.
I think it's hard being self-aware, and that's sort of nuanced, right? So if someone is a dynamic presenter and can articulate their business very well, and obviously give confidence that people want to aspire to work for you or with you and do their life's best work, that's great. But then when we, you know, where we come in, there's actually things that we can work with, people, teams, business models, things like that, you know, are you filling out the rest of your team as much as you can with where you're weak? And it's sort of a representation. Are you going to hire the best possible people into your business, and are they actually filling out where you potentially are weak? And having those conversations, frankly, early on about what you need shows tremendous value to us in terms of coachability and a partner that we can really get behind to scale business.
Thank you. Those are actually actionable insights, I think. So appreciate that. Anybody in the audience with questions either for an individual up here or for the panel as a group?
I think Kathleen highlighted a macro trend that I didn't heard addressed. You mostly were talking about it from a finance standpoint. But this whole business of the middle class and what's going on, and that half the people are going to be on 1099, and that I think most parents are telling their kids to become their own thing when they grow up. What other macro trends are there out there that you guys have thought about in that area? This isn't necessarily a question for me as much per se, but it's an area that I think about a lot, and I'm curious of your insights on it.
Yeah, so kind of going off one of the subsegments of what we saw as the macro trend, one, right, everything's moving to the cloud. I hate to even use that word, but everyone, everything is. It's really easy for startups to start businesses and hitting some of these real important areas. We see the demographic shift, and that's where more immigrants are coming in the country. You have millennials that are coming up, and then you have the baby boomers that are now coming of age where they should be retiring, but they don't have a lot of savings. A lot of my stuff is going to be financially service driven because that's what I'm focused on. And so you see that demographic shift, and so that's why you see the sub-segments, and you see a lot of contract workers. You see a lot of changes in companies coming in that are doing UI UX for banks, people that can just take solve small little problems because it's easy that they can solve small little problems, and they'll solve it for the population that is the most vulnerable. And the biggest, I think the biggest shift what we've seen is it's not just the un and underbanked that are vulnerable, it's the whole middle class. People don't have savings, really looking at anything that can provide financial security. So things like insurance, things like healthcare payment platforms. 50% of all bankruptcies are caused because someone has a healthcare incident and then can't pay their bills. And so you're starting to see, because of all those shifts, that startups are actually going to solve those problems, right? Because they have a family member, they see something happen, and they see this is a huge issue. What I'd encourage all of you, especially you that are just doing another app, to look into financial services and solve these are big issues, and we believe bringing market-based solutions to big issues are the best solution, and the more value you bring to the consumer, the more your enterprise value will be. So please do not do another Yo app, and please hit one of these big issues. Yeah.
Yeah, I mean, there's obviously the stuff that media pays a lot of attention to, connected devices, Internet of Things. That's becoming a big trend, and we're seeing a lot of stuff in there. But I think one of the really interesting things that we've seen is kind of the disintermediation of some of these established business through marketplaces. And I mean, obviously, marketplaces, marketplace business are something that we're hearing a lot about and seeing. But actually, I mean, take a deal that we're in with FF called Print.io. I mean, these guys have really disintermediated the print broker and become kind of the AWS of printing. We've invested in another company that's done that with with the venue business. And marketplaces are hard to get, obviously, both sides up and running. There's always the inevitable chicken and egg problem. But once you get them up and running, and you're really kind of disintermediating a industry that's been around for a long time, we think there's a ton of value in them, and you can do them on a pretty light amount of capital. So I think we're seeing a lot of that stuff.
Technology is hard to predict, so let me give you a prediction that is 100% accurate. The people who are going to run corporate America 20 years from now, they're alive today, right? Some of them are in this room, and they don't look like the people on this panel. So America is a majority-minority country by 2042. Already the majority of students in colleges are women, so the leadership of America is changing. And that's something that I think is particularly interesting, because I operate in an industry that's 76% white male and about 90% male. So most VCs are not really aware that the marketplace is changing. At Harvard Business School Angels, we launched an initiative focused on reaching out to women and minority entrepreneurs because we thought that there was significant opportunities that most of our peer group were not noticing. And that has created a lot of new investing opportunities for our members. We've also organized a series of joint pitch nights with the Harvard Business School alumni groups for African Americans, for Latinos, for LBGT folks, including, as of today, Tim Cook, not an HBS grad, LBGT. So with that, it's been a way that we can connect with more people in the Harvard community and, again, source entrepreneurs whom other VCs in my homogenous industry are not paying enough attention to. So from the vantage of point of an individual founder, I would think about who's buying your product and how they're changing and how to market them, because it will look different prospectively than it has historically.
One maybe industry trend and one high level sort of observation. I'm in sort of the media world. It's such early days for advertising technology as it meets the cloud marketing suite. What's going to happen? What is obvious, CMOs have no idea. And the power, frankly, social data is something they need to get their heads wrapped around. And I think there's some real innovation and white space that's happening in the new crop of vendors that are solving these problems for how consumers actually engage and consume content and what that means to developing a relationship with brands over time. At a high level too, if you kind of look at just software as it as it eats the world, complexity sucks. And I think the companies that are going to win simplify the process for the consumer or the end enterprise. So you've seen that in multiple industries, Apple, Square, and I think you're going to see it in multiple industries now where there's just way too many vendors and point solutions that we're advising our companies is sort of how do you simplify this and make it an elegant UI and deliver true sustainable value to customers, and those companies we believe will win.
All right, one more question, and we're going to have Andrew's going to get up here and give his quick pitch as well. Question? Anyone?
I mean, this was a great event, but sometimes I feel guilty when I come to this event because I think I should be in the office or like talking to clients. Do you guys see like this as valuable like source of like leads for you, or it's something that you are doing mostly for PR and put your name on there?
I mean, let me answer that because you always get two sides of the opinion on things like this. We're huge supporters of any events that support entrepreneurs and the ecosystem, as we're a little bit upstream. This is our lifeblood. So anything we can do to be a resource and support and share ideas or network, we're all about. We're out shaking our tin can for our next fund. So we're humbled in a little different way than you are. Your job's a lot harder than ours. But from first call to doing a deal is 33 months in our firm. With companies that raised less than $2 million in capital at an $8 million run rate, growing 70%. So to find those unicorns, we do everything we can.
Anyone else?
Yeah, I mean, I can take a stab at it. I mean, look, I think there's a lot of as part of a number of books and anything you read about clusters and so forth being so important to creating a thriving startup entrepreneurial society in a given geographic area. If you don't look at these as part of especially for us that are East Coast guys, creating this East Coast ecosystem, and most of us up here I think truly believe that New York has a real opportunity to become over the next 10 years a very massive player, and it's just in the very nascent stages of doing so. In the VC community, and so I think for most of us, we realize unless we come to these events and spend a lot of time getting to know everybody that's kind of in the ecosystem, you're not really doing both the ecosystem or yourself any sort of justice. So we try our hardest to do this, and we try our hardest to meet as many people as possible here. And we've had deals come out of these things, so that's a value.
So this is a question that's close to my heart. I wrote a large research study on origination. How do private equity and VC funds find deals? Which is the exact opposite question that a founder worries about, which is how do I get money? So I'll tell you some inside baseball about VC. There's a group in New York called the Young Guns of analyst and associate level VCs. They get together, they network, they try and get a better job, they complain about their bosses, meaning me, right? And the junior people at other VCs, they tell me a big part of their job is going and shaking hands and networking at events like this. And that's great, and they enjoy that. That's not the model at FF, right? We did send, one of my colleagues was here this morning, met with a bunch of companies, and hopefully that will result in some meetings, and hopefully it will result in an investment. But we spend a very small amount of calories as a firm on that sort of outbound outreach. Instead, our model is try and be the most attractive investor in the room, not physically, definitely not, but the most value-added investor in the room, and let that inbound deal flow come to us. And that's how we get 2,000 inbound companies a year. I think both models, the proactive and the passive, are valid and work. Firms like Summit and TA and Insight are prominent VCs that have invested a lot of calories in that outbound effort and have done well. But I do like our model because it means that our calories are spent primarily on companies in which we have invested, and that results in a positive reputation, as opposed to companies, 99% of which we will not invest in, right? Because that's the filter. We and most VCs invest in about 1 out of 100 companies.
Thank you.